Welcome back to Legacy, the Business Succession Podcast. I'm Jared, your host as usual. In the first episode, we discussed why every business owner needs a succession plan. Today, we're clarifying something that causes a great deal of confusion, even among experienced business owners. What is the difference between exit planning and succession planning? These terms are often used interchangeably, but they are not the same thing. And misunderstanding the distinction can lead to incomplete planning and unintended consequences. This episode is for educational purposes only. It is not specific legal, tax, or financial advice. At a high level, exit planning and succession planning answer two different primary questions. Exit planning asks, how do I leave my business in the most financially efficient way? Succession planning asks, what happens to the business after I'm no longer leading it? Those questions overlap, but they are not identical. Exit planning is largely transaction focused. It centers on value optimization, valuation, deal structure, tax efficiency, timing, negotiation strategy. In Canada, that often means planning around the lifetime capital gains exemption. It may involve corporate reorganizations. It may involve purifying passive assets. It may involve deciding between a share sale and an asset sale. Exit planning is about extracting value from what you have built. It's also about protecting your personal financial outcome. Succession planning, on the other hand, is continuity focused. It's about what happens next. Who owns the business? Who leads the business? How are decisions made? How are employees reassured? How are family expectations managed? Succession planning looks beyond that transaction. It looks at the sustainability of the enterprise after transition. To make this more concrete, imagine a construction business owner in Alberta who receives an unsolicited offer from a competitor. From an exit planning perspective, the analysis might look like this. Is the valuation strong relative to EBITDA? How will the proceeds be taxed? Is the capital gains exemption available? Are the payment terms secure? What representations and warranties are required? Those are all valid and very important questions. But succession planning would ask different questions. What happens to long-term employees? Will key managers remain? What happens to family members working in the business? Does the company culture survive? Are there earnouts that require continued involvement? Is the leadership team capable of operating under new ownership? A transaction can be financially successful while still being operationally distributed. Conversely, a family transaction can preserve culture and stability while creating tax inefficiencies if structured poorly. When owners focus exclusively on exit mechanics and ignore succession continuity, blind spots tend to emerge. Here's another common example. An owner spends years preparing for a third-party sale. Financial statements are all cleaned up. Corporate structures are all optimized. Tax planning has been discussed and implemented. Then the deal falls through. If there has been no succession planning, no leadership development, no government structure, no clarity around long-term ownership, the business may still be heavily dependent on the founder. The exit plan was built, but the succession foundation was not. The result is frustration and fatigue. The two concepts are related, but they operate on different timelines. Exit planning is often event-driven. A strong market, an unsolicited offer, a health event, or a retirement decision. Succession planning is ideally proactive and gradual. It unfolds over years. It involves incremental leadership delegation, and it involves communication with one's family. It involves strengthening your systems within the business, and it involves documenting roles and expectations. Exit planning comprises time. Succession planning expands upon it. When succession planning is delayed, exit planning becomes reactive, and reactive planning reduces your options. The strongest outcomes occur when both are integrated early. When financial optimization and continuity planning are aligned, that means asking both questions simultaneously. How do I maximize my value? And what happens after I leave? For growth stage business owners, particularly those who are incorporated and beginning to accumulate retained earnings, this distinction matters. You may not intend to exit for 10 years, but succession planning does not require an imminent sale. It requires intentional preparation. You can begin developing management depth long before you begin negotiating a transaction. You can clarify family expectations long before ownership transfers. You can strengthen governance long before retirement. When these elements are built gradually, exit planning later becomes smoother and less stressful. If there's one mistake I see repeatedly, it is assuming that completing a transaction equals completing succession planning. Signing a share purchase agreement does not guarantee business continuity. Selling shares does not automatically create leadership stability. Transferring ownership does not automatically align expectations. Succession planning is broader than documentation. It is structural and relational. Let me summarize the distinction clearly. Exit planning protects your financial outcome. Succession planning protects the business itself. Exit planning asks you what remains. Both matter. Neither is sufficient on its own. 3 practical takeaways to focus on. First, exit planning is transactional. Succession planning is structural and relational. Second, focusing on one while ignoring the other creates risk, either financial inefficiency or operational instability. Third, the earlier these 2 perspectives are integrated, the more flexibility and confidence you retain. If you are unsure whether your current plan is focused solely on exit mechanics or whether you have addressed broader succession continuity, we've created a structured business succession planning book that is available on our website at legacyllp.ca. It'll walk you through the major components of succession readiness and help you identify further conversational points. It's designed as an educational framework to support clear thinking. Again, it can be downloaded from legacyllp.ca. In the next episode, we will discuss when you should actually begin your planning and why the timing is often earlier than you might expect. Thanks again for listening to Legacy, the Business Succession Podcast. If you're planning something meaningful, it deserves thoughtful transition. We'll talk again soon. Thanks.